So step number one for this trading strategy is to identify our supply and demand. In this case, we see two very strong green candles indicating a significant demand shift. What you also can notice is that the origin of the demand shift completely engulfs the four previous candles. And as we talked about earlier, that is a good sign. Using our cluster of candles method, we draw a demand zone like this, and we extend the demand zone here to the right. But what we also can notice is that before this demand zone appeared, we saw a very strong supply shift. We once again use our cluster of candles method and draw a supply zone like this. And to keep it simple, let's say that we are a trader that are looking for bullish trades, or in other words, we're looking to go long. And we don't want to go long here on the initial move. What we are waiting for here is that we're waiting for the price to come down to this demand area once again, and then we're looking out for a reaction of this area. So the next part of the strategy here is pretty much a waiting game. As new information comes in, you might need to adjust your demand or supply zones according to new information, which we talked about earlier. And at this point, you might need to adjust your supply area once again according to the most recent information. But now, as you can see, the price has finally came down to our demand area. And what we're looking out for here is that we're looking out for a reaction of the demand. So in this case, you saw the price wicking down to the demand area multiple times. And then we saw a strong green candle, and this can actually act as our entry signal. So we enter our long position right here. There are two main ways to set your stop loss. One method is to simply set your stop loss just below the lowest point here of the reaction. Another method is to set your stop loss all the way below the lowest point of the demand zone. However, for reasons that you will see very soon, we decide to set our stop loss just below the low. And as for your target level, you can either aim for a fixed risk to reward ratio, such as a 2-to-1. This basically means that the reward is twice as big than what you lose if you lose the trade. But what I prefer to do here is to look at previous supply and place the target a bit below the previous supply area. And if we let this trade play out, we can see that initially it went in the opposite direction, but as the trade went on here, we eventually reached our target level. You can see we actually did get a strong reaction here of the supply area. And what you also can see here is that if we continue to play out the price, you can see that we got reacted again. One time we saw a small reaction here before the price finally pushed above. And what you also can notice here is that even if we set our target level higher up, so if we set the target at our supply area, we would have still locked in some nice profit. All right, so if this strategy felt confusing, I highly recommend to watch our full supply and demand trading course here on the channel. This video right here was actually just a very short clip from the full course. And to watch the full course, simply just click or tap on the screen right here.